Welcome to today's GNCC Espresso webinar, all about the state of our economy and how it impacts businesses and individuals. This week and in the upcoming ones, news headlines have and will focus on a significant amount of economic updates. Yesterday, data showed that Canada's annual inflation rate came in at 3.4% in May, its slowest pace in 2 years. Stats Canada said month over month, the consumer price index was up 0.4%, a tick lower than forecasts. Another data shows Canadian employers have added more than 230,000 jobs so far this year. And last week's retail sales figures have not seen and indicate that there is no slowdown in spending. So, what can we expect on July 12th from the Bank of Canada? Are we faced with a raise of interest rates one more time? And what do these indicators and any of them actually mean to business? Will organizations adjust their hiring and investments for the second half of this year? How are households managing inflation, higher borrowing costs, and will this mean that consumers intend to slow down their spending? As you can see, there are many questions, and my name is Mishka Balsam, and I will be your moderator for this morning, as we have an amazing panel of 3 experts who will shed some light on all of those questions. These questions are important, they're important to business, and they're important to individuals. But before I introduce our panelists, let me acknowledge that today we are powered by, and this particular espresso is powered by Meridian Credit Union, Ontario's largest and Canada's second largest credit union, helping to grow the lives of more than 370,000 members of theirs through their 89 branches and 15 banking centers. And here to actually speak to us about Meridian Credit Union is Greg Dalton, the Regional Vice President and Private Wealth Management for Meridian. Greg, over to you.
Thank you so much. And first off, just want to say thank you to Karina, Amy, Mishka, everyone at GNCC for giving us the opportunity to be here with all of you today. As Mishka mentioned, for any of you I haven't met before, I'm Greg Dalton, the Regional Vice President, Private Wealth at Meridian. Meridian and GNCC have had a lengthy and strong relationship with one another in working towards our mutual goal of building a prosperous business community in Niagara, and events such as this are just another testament in achieving that goal. So we really appreciate the partnership and hard work. Previously in January of 2023, Meridian actually just launched our private wealth team, which was an evolution of our growth and in the wealth space within Niagara and across Ontario, as Mishka mentioned, with our 370,000 plus members that we've been working with. And so we're really excited to start to engage with all of our members and prospective members as well within the Niagara community in terms of how we can help and continue to contribute towards the growth of Niagara, the growth of our members, the growth of our GNCC members and community. So we're really excited to be here and be a part of that partnership today. Our topic of the current economy and its impact on Niagara businesses, it really couldn't be more timely. Mishka mentioned a few of the items there. We had a relatively unexpected interest rate hike. The housing market is still very strong. Cost of living increases, making it harder for everyday people to budget and balance their finances, market volatility, and of course, there's always that fun lurking 2024 election that's coming down south as well. So, we have 3 accomplished expert panelists here today, and Stephen, Paul, and Jordan, that we're really excited to discuss some of these events and what that can mean for both you personally and as a business today and into the future. So we encourage some questions, and if there's anything further that we can assist with, our contact info will be available. And don't hesitate to get in touch with us, as a well-tailored financial plan for you and your business will always be the key to successfully navigating uncertain times. So thank you again, Mishka, and I'll pass it back to you to kick us off today.
Great, thank you so very much. And we equally appreciate and value the partnership that we have with Meridian Credit Union. I think even when I take a look at it in the concept and light of an economy, I think, and what we see in the business community, it's the partnerships that make such a difference. So thank you for that. And on that note, it is my great honor to actually introduce our panelists to you. We have 2 individuals with Meridian Credit Union who are with us today. We have Paul Shelestowsky, who is an investment advisor and he's a certified financial planner holding a chartered investment manager designation. And with over 25 years in the investment industry, he specializes in helping individuals find tax-efficient income replacement solutions. You might have enjoyed his many financial articles and editorial contributions to various local and national media outlets. And also with Meridian Credit Union is Jordan Damiani, a senior wealth advisor and expert in creating something we all need, and that is peace of mind through financial planning. He is a University of Toronto grad who holds designation of Certified Financial Planner, Trust and Estate Practitioner, and Registered Retirement Consultant. And then with the Canadian Chamber of Commerce, we have their Chief Economist, Stephen Tapp, with us. He brings over 20 years of diverse experiences at many of Canada's top economic organizations, including the Export Development Canada, the Bank of Canada, Finance Canada, and a number of think tanks. He holds a PhD and MA in economics from Queen's University and an honors BA from Western. Gentlemen, thank you very much for being with us this morning. And to our participants and attendees, many of you are likely familiar with our format. This one today is going to be a very interactive one. So we thought instead of having a normal format, which is part of presentations and then just leaving 15, 20 minutes for questions, many of you have already shared so many of your questions with us, so that we kind of thought the best format to move forward with is an interactive one. If you have not submitted your question yet or haven't heard your question but are interested in asking one, please utilize the chat function for that. And that's a button at the bottom of your screen. And if you wish to enable live transcript, please refer to it on your Zoom screen as well. And lastly, just a heads up that today's session is recorded, and a recording of this webinar will be made available to you after the conclusion of today's session. Well, on that note, I thought let's start with one really easy question. Maybe not that easy, but maybe just to start the dialogue going. I mentioned in my opening remarks, and Greg also actually referenced a few of them, the news highlights on our economy. And so I thought of asking you, what are the key indicators that you personally look at to access the overall health of the economy? And what do they currently suggest about the economic state of our country? Because we chose a few, but you personally might say, here are the three that are worth looking at. And to start it out, maybe Jordan, if I pass it to you first, if that's all right, and then followed by Paul and Stephen. If that order works for you?
Yeah, no, that's perfect. And yeah, big thank you for having Paul and myself here. I know we're excited to chat with everybody. So I think, from a financial planning lens, it's interesting because, you kind of threw out a lot of economic indicators, and there's always a big disconnect between the real economy that a lot of the GNCC members run a business in and financial markets. So, as a financial planner, we know that, financial markets are leading indicators. So a lot of times, we see that volatility last year, and now we're seeing some of those data points spill out, this year. So I think for myself, one of the big ones is, if rates are going up this year, it's intended to slow down the economy. But the challenge has been the Canadian economy has been fairly resilient. So one of the stats being unemployment, it's been pretty stubborn at 5%. Really low levels since December, actually ticked up a little bit to 5.2% in May. But the challenge is, with the Bank of Canada raising rates and unemployment staying really high, it's creating a lot of wage inflation. And, if employers are bidding for talent and, it's going to be tougher to see that overall inflation number come down. 3.4% is definitely encouraging, considering it was 8.1% in June of last year. So that's pretty exciting. I guess, the other one would be just, I just mentioned the CPI figure. So 3.4%, the Bank of Canada's target is anywhere from 1 to 3%, ideally 2. It was always anticipated that getting down from 8.1% to just say 4, that was going to be the easy job. Getting down from 4 to 2, that's going to be difficult. And, the challenge is, how much does the Bank of Canada slow the economy to bring inflation down to their target, effectively creating pain for borrowers and even putting downward pressure on financial markets doing that. So that would be the other one. And I think actually for me, another stat would just be immigration as well. I mean, one of the things that I don't find is talked about as much is Canada expects 465,000 immigrants in 2023 and almost 500,000 for the next 2 years. So when we kind of talk about the housing market, we talk about the labor market, we are getting a lot of immigration. Specifically, they call them economic immigrants that come over that are, highly educated, that have savings, that want to buy houses. So again, we're almost in this purgatory where all the data is showing us that, okay, we're trying to slow things down. Are things slowing to bring inflation down? But we've got all this, positive data coming in, and it's kind of, slowing that inevitable recession that we all thought we would have in the first quarter. So those would be my kind of 3 points there.
Thank you so very much, actually. Paul, if I could pass it over to you.
To add to Jordan's there, the other one that we follow quite a bit in the financial world is the yield curve. So the yield curve, really, you can think of it as a GIC. Normally, if you get 4.5% rate of return for a 1-year GIC, you're going to get maybe 5.5% for a 5-year GIC. So the longer that you hold the GIC for, the more you're going to get paid. So you get paid to take on the lack of liquidity. We're in an inverted yield curve, meaning you actually get paid more for short-term GICs than you do for long-term GICs. And I think it's something like inverted yield curves have predicted 9 of the last 6 recessions. So they tend to over-predict the recessions, but they are a pretty good indicator. People don't want to lock in for longer periods. They want to take the short-term rates to make sure that as the rates start to come down, whether it's a mortgage or a GIC, they can take advantage of the yield curve straightening back out. So we've been in an inverted yield curve for about the last 8 months. And usually the recession comes 8 to 18 months after the yield curve inverts. We tend to see a recession. The other one we follow quite a bit too is that tends to be a pretty good accurate indicator is the PMI number, the Purchasing Managers Index. And that is an index that comes from every country across the world. And if the PMI is above 50, that country is in expansion phase. And if it's below 50, they're in a contraction phase. And most of North America is sitting in 46 to 48 range. So that tends to show some future contraction as well. And over to you, Stephen.
Yeah, thanks. So in terms of which indicators we look at, I think we try to look at all of them. The Business Data Lab has a business conditions terminal, and what we do is put them into different buckets. So we've got things on the overall business sentiment from surveys and Outlook, the labor market data. We've got financial conditions. There's a whole bunch of data information there. Tourism, transportation, trade, the sort of different lenses through which you can look at the economy. I think Jordan had mentioned on the labor market side, the unemployment rate, which is obviously a key indicator of how tight the labor market is. So in addition to that, on the labor market side, one of the indicators that we focus on is labor market tightness. And what labor market tightness does is that it looks at labor demand, which is the number of job postings or job vacancies that businesses are trying to fill. And you look at relative to the number of unemployed people that are looking for work. And we've sort of seen a significant tightening in the labor market, which is similar to what you'd see in the unemployment rate, although in a different direction, which is starting to come down now. Labor markets have started to loosen, but are still extremely tight. We look at hours worked, which is a good indicator for gross domestic product to give a better sense of what's happening for overall output. I would say on the inflation front, we did get good news from the Bank Canada's perspective. I think yesterday was relatively good news for inflation, looking at the year-over-year rates coming down. But one of the things that we also focus on there is core inflation. So not just overall headline inflation, but what's happening when maybe you remove some of those volatile components like food and energy. And instead of looking at the year-over-year rates, or in addition to those, looking at what's happening in a shorter term. So let's say what's been happening over the last 3-4 months, and if that were to continue, and those indicators are actually less suggestive that inflation's coming down and that there's a bit more pressure in the system. So shorter run, core inflation measures are still running around 3.5% or a little bit higher. So that's not coming down as quickly as overall inflation, given the fact that we've had the energy price spikes before. Of course, for the labor market, we are focused pretty keenly on wages. Wage pressure is about 5% right now. So wages have taken a while to get up because we had the big spike in inflation, but wages are starting to run now a little bit above what probably most businesses would like and what output is being produced per workers. On the spending side, we have a spending tracker, so a local spending tracker for the Business Data Lab, but I can include some of those links in the chat for folks who want to look at those. That's a leading indicator data which we purchased from Moneris, which is a point of sales provider. And that's starting to show on the retail sales side from StatCan, you have seen, reasonably robust spending. But when you take into account the fact that we've had high inflation and the immigration data that Jordan talked about, there's a big influx of people. Real spending per person is actually, in terms of growth rates, has turned negative since the middle of March as we're looking at those data. So that's a little bit more concerning. And when you look across the major cities in Canada, we're seeing some pressures there. So I would say, yeah, try to look at them through the lenses of the business side, the consumer side, and then it's a pretty mixed bag right now. And I think forecasters and many have been expecting a recession for quite a while because the Bank of Canada has hiked interest rates to try to control inflation. But the economy's been pretty resilient. Businesses have been optimistic, and we're still not there yet, and kind of going through with a lot of uncertainty and maybe slowing momentum. But economy is still chugging along pretty well in general.
Thank you very much. Actually, all of you have spoken and given us some data points to look at, ways to actually for us to assess the economy. What keeps you up at night? Are there anything that makes you supremely confident about a short to midterm economy? And or are you really concerned about it? And Stephen, maybe if I start with you, and then I'll bring everyone else in.
I think to understand what's happening in the economy right now, you really need to be focused on the battle to bring inflation back to 2% that the Bank of Canada is so squarely focused on. And so, what keeps me up at night would be the concern. I think this is a concern that Bank of Canada Governing Council officials have, is that we've seen some decent progress in terms of reductions in year-over-year inflation rates. We're back down now to more normal rates of inflation on a year-over-year basis, about 3.4%. But I think the real worry that I'd have, that bank officials would have, is that we have a lot of underlying momentum in the system and a lot of cost pressures on businesses. So businesses are still in a position where the cost of labor is going up, a lot of input costs are going up, from transportation costs to insurance costs to interest rate costs, because the Bank of Canada is raising interest rates and loans. So I think the main concern would be that we essentially get stuck at a point where inflation has come down from that excessively high level, or a little bit over 8%, last summer, but that we don't settle back into 2%, and when we get in somewhere around 3.5%, and it's really difficult for the bank and others to sort of adjust and get it back down to the midpoint of the target that the bank would like.
Thank you very much. And maybe if I pass it on to Paul and then to Jordan on the same one, the question is like, what makes you supremely confident about the short to midterm, but maybe what also keeps you up at night?
Yeah, it's kind of hard to be supremely confident because there's a lot of red flags as far as a recession coming, but there's also some green flags too. And a full-blown recession, a deep recession, can be a huge wealth eroder for people, especially if your balanced portfolio that you're investing in is heavy into stocks, because it will do a lot of damage to the stocks. But that's not keeping me up at night terribly, because it is hard to have a really deep recession with record low unemployment, because that is one of the big engines that drive the economy. If unemployment starts to shoot up, then we certainly could see a much deeper recession. I would be more inclined to see a soft recession, which from what I can see would be a technical recession, but without all the market destruction. And that a lot of that market destruction that would normally come with a deep recession really can be pointed back to 2022, where we saw, especially in the States, markets down 20 and 30%, which is a normal downturn for a deep recession. So I'm kind of on the fence. I'm not deeply concerned about anything, but I'm not overly confident either.
I actually appreciate your comment, Paul, because I think it mirrors what a lot of businesses feel too. There's an uncertainty, there's an ambivalence about it, but not yet the sense that we're heading in the wrong direction, or it's all heading in the wrong direction. But so I think what you have expressed is often mirrored in the business community. And Jordan, over to you.
Yeah, thanks, Mishka. And just to maybe echo some of Paul's comments. So, as a financial planner, the only thing that really keeps me up at night is almost the behavioral psychology element of, keeping people on track, keeping them on plan, and keeping them invested. And I think the challenge, and call it over the last 3 years, not even necessarily just the last, year or so, it's been really difficult because of the volatility and distortion. If you think of having rates almost near zero, and all of a sudden, the policy rate at 4.75%, up from 0.5. I mean, it's just creating extremes, just really to deal with the fallout of the pandemic. So, as much as you put the work in, there's scary headlines. There's a lot of impetus to say, well, wouldn't it be better to go to cash or be more conservative, or kind of step away from the planning? So I think that piece would keep me up at night. I think what, I wouldn't say supremely confident, but the confident element is, just kind of going back to the way market cycles normally work. And, I think by all accounts, we would probably, agree that we're, probably close to the end of the rate hike cycle in terms of, I don't know that anybody expects another 2% of rate hikes from here. That's why you're kind of seeing, 0.25%. Then there was a period of a pause. We saw a 0.25% hike in June. And even if we do see a hike in July, it might be 0.25% as well. From a market standpoint, markets really like a period where there's more certainty. Certainty can come with just telegraphing that maybe the rate hike cycle is over and the next move might be a cut. So one kind of stat that gives me a little bit of confidence, this was kind of Fidelity research, was usually preceding a recession. This is a US stat. The S&P 500, it tends to be down about 33% on average. Now, we saw it be down 28% at the low in October of last year. So, what that tells us is the market, for the most part, was almost pricing in a full-on recession that we actually didn't have yet. And even to echo, Paul's comment, even if we do have one, because the economy is so resilient, because unemployment's been so strong, it's probably not going to be a crisis level one. It's not another 2020 or 2008 or 2000. And I think those comparisons are really, spooking a lot of people. You wouldn't have this strong economic data if the economy was ready to fall off a cliff, in my opinion. So I think it's just, to summarize, what keeps me up at night is just really people staying on track. And I think, if we sat here in December, of this year, it's going to look a lot different, and there'll be a little bit more clarity than there is today. You're just on mute, Mishka.
Thank you. You just spoke about, Jordan, about the Bank of Canada that have been aggressively raising the interest rate in an attempt to rein in inflation. Actually, all of you have mentioned it. There's a theory and their theory is that the rates rise, consumers are squeezed by higher debt payments. And Stephen, I was wondering, is their monetary policy successfully slowing the economy and reining in inflation? Is it reaching the results that they're hoping to see?
It's a hard question to answer, because I would say, we look at the Bank of Canada, we focus on the Canadian situation, but the same the same issues are happening south of the border in the US. The same issue is affecting Europe and the European Central Bank, the Bank of England, everybody, central banks across the world, because of the pandemic, because of Russia's war in Ukraine, because of supply chain snarls and other things. There's a whole series of shocks that have hit the economy. I think they're doing their best to try to make sure that inflation expectations come back to some normal level around 2%, and that we kind of work our way through these big shocks. So I would say, in general, the policy that they're pursuing to raise the cost of borrowing to try to slow the economy down is the right one. And it's taking, much like many thought that the inflation shock itself would be relatively transitory and short-lived and would be over by now. This is taking longer, and it's proving harder than I think most people expected. But at the same time, as I talked about before, it's clear that momentum is slowing in the global economy and momentum is slowing in Canada's economy. So it's clear that the higher cost of borrowing is going to be impacting households and businesses, and particularly those that are most indebted. If you're rolling over your mortgage now from a period of let's say 3 to 5 years earlier, you're going to be faced with a lot higher level of interest payments than you had before, and that's going to curtail some of your spending and other things. So I think we are going to get there. We're going to see that happen. Consumers, I think, slowing down a little bit, but we had a period where there was a lot of savings that had built up, particularly for people that are working remotely with educations or college degrees and the like, able to work remotely, keeping their jobs, and then not being able to spend on travel, tourism, entertainment, and things. And so we did have, I would say, a buffer of savings that we're working our way through, and that's kind of keeping the consumer side going. So yeah, I mean, in general, I think that the bank's policy is on the right track, but we're not getting back to 2% quickly. There's a lot of global factors that are happening. The bank doesn't, uniquely control Canadian inflation. There's a lot of other things that affect it, but it's really their number one job is price stability. And I would just make one point at the end of the day is even kind of reining in inflation. Yes, we will get back to a point eventually where prices are growing at 2%. But we've had a very massive overshoot in inflation where prices rose a lot in the pandemic. And so getting back to 2%, it's still extremely, affordability is going to be an issue going forward. Even if we have prices growing at 2%, housing affordability is an issue for most people. Businesses affordability input costs are an issue. So that's going to be a lasting concern of the pandemic, even if the Bank of Canada can sort of, declare victory if we get back to 2%.
Yeah. Seemingly making some excellent points, and I actually do want to talk about the housing one, but before talking about it, you had also made mention that the money is more going towards servicing their debts, and Canadians have less of it to spend anywhere else. And Jordan, what changes are people making in their spending patterns that you're observing? And Paul, the same question goes to you, but maybe if I start out with you, Jordan, because you're dealing with individuals, do you see a change in spending habits and spending patterns due to the economy?
I do. And I think, with Paul and I's roles, we're a little bit skewed because we tend to, deal with more affluent Canadians. But, it's funny, we kind of see the shocks with a lot of their kids and just, I'll call it affordability crisis with housing and a lot of behavioral change. And I would argue that's what the Bank of Canada intends. I mean, that's why rates go up, to force behavioral change. They want to slow down the economy by pulling money out of it. And you kind of see things pop up through the woodwork. So a good example is, I think when rates were near zero, when you could borrow for, a couple percent, there were really no, I think, impetus for aggressive debt repayment. It was actually, I wouldn't say discouraged, but, if you were making 6 or 7% on investment, there was almost a little bit of arbitrage there if you could borrow for 2 in that case. So you weren't seeing a lot of prepayments or aggressive debt repayment. I feel like you are now. The other one too, I think with a lot of, the business community specifically, a lot of that money is being parked because they tend to be a little bit cautious. I think a lot of them are very just concerned about the uncertainty that we've talked about on the call. So they want some dry powder. So maybe money that would have went into the financial markets is being parked now. And especially with, attractive rates at about 5%. So yeah, on money market or GICs. So that's kind of the biggest change this year is, inflows that would have been invested, are really a lot of money is being parked on the sideline. Now, ironically, from a financial market standpoint, that tends to be an incredibly positive indicator, as you move forward, because, it's almost like the fear of missing out. As markets start recovering, as, it's telegraphed that interest rates are probably going to be on their way down, you see that uptick in the market. Likely, deposit rates also start going down, and a lot of that money shifts back into financial markets, and it creates a good uptick. So I think, it's really more focus on debt repayment, and definitely a huge focus on cash-based savings over market-based investment at this point.
Actually, Paul, before passing it over to you, I think John made an interesting point where he differentiated between what it means to households versus actually businesses. Are you seeing as many businesses borrowing to invest, or are they preferring to sit tight, as Jordan had mentioned? And then my second question related to it, if they are preferring maybe not to invest right now, are there certain sectors that are holding off, whereas others are moving forward?
Yeah, from Meridian's point of view, we're actually not seeing, on the business side of things, we're not seeing any sort of shortfall in lending applications. We're still seeing the same volumes coming through. Unfortunately, that means the businesses are paying a much higher rate to borrow, but some of that can be passed off through higher prices or higher service costs, and then again leading to the inflation. That's how it gets passed on to the consumers. But we're not really seeing the businesses, they're still investing in their companies, because I think that, you know, if you sit on the sidelines too long before investing back in your company, then you run the risk of missing out on future revenues. So it's sort of that trade-off, short-term pain for long-term gain, but it's across all sectors as well. We're not really seeing any business sectors that are sitting on the sidelines waiting for the rates to get lower before they take out debt to invest in their company.
And I think this is actually an interesting topic, because when we talk to businesses, some of them that are holding off investment, it's also driven by the challenges in the labor market. Actually, two facets of it. Some of it is supply chain, but other aspects of it are also the labor market. And Stephen, I was wondering, we are experiencing historically low unemployment rates right now. How do you see the labor market developing in the next few years? And then maybe as a secondary follow-up question, if I can also ask the supply chain, if that is holding back businesses of investing right now.
Sure. So let me take the labor market question first. I mentioned at the outset, you know, labor market tightness is a measure that I look at. So overall job postings, or these vacancies from firms and unemployment. We still have almost 800,000 job vacancies right now. So that's jobs out there, employers that are posting and looking to hire those jobs. So I would say the labor market is still extremely tight from the perspective of, if you're looking to hire workers, it's difficult to hire workers now, and there's pressure on wages. If, on the other hand, you know, you're out there looking for a job right now, it's a great time to be looking for a job from an applicant's perspective. But we still have the overall unemployment rate 5.2%. It's near generational lows. So I would say labor markets are tight. When the question kind of moves forward to looking ahead, I would say the demographic situation that we're in, and we're going through the retirement of the baby boomers. I expect labor markets to remain tight, and tighter than they were before the pandemic, for, you know, the indefinite, the near middle term, let's say next 5 or 10 years at least. You've got a lot of boomers retiring. Now, on the other hand, we're bringing in, on the immigration side that Jordan mentioned, we're bringing in up to almost 500,000 immigrants at this point right now, and that's hoping and attempting to fill some gaps we have in the labor market. But that is having its own challenges for housing affordability, housing availability, healthcare, and others. So I would say we're in a tight labor market. I mentioned our business conditions terminal. We do a ranking in the executive summary section of, you know, a 1 to 5. From the perspective of businesses, this is still a 1, meaning very challenging. It's still a very, very challenging labor market, and we don't, you know, maybe it'll be 1 or 2 out of 5, but it's unlikely to move in the direction of, you know, ample labor and easy hiring time anytime soon. So let me skip up to the second question you had on the supply chain side. We have seen a lot of improvements in supply chain over the last year. So, you know, before, if you go back a year and a half ago, we had very big increases in overall prices. Shipping costs, I think, went up by a factor of 3 to 5 globally. And in some cases, depending on which direction and which ships you were using, it went up by more. We had floods out at the end of 2021, in BC, which had some impacts and sort of challenges there. But when we look at the data that we've got for measures of the fluidity, the timing that it takes for deliveries, all those things have improved. And the one wild card was China. China essentially had a bunch of COVID zero policies. They ended up relaxing those. And I think China's rebound has been a lot less impressive than most people had expected. And that itself could have posed more problems for supply chains. But because China's economy has not really popped as much as people thought, I think supply chains have improved. However, if you're trying to buy a van or a car, and, you know, in the new market right now, you know, you can call dealers, and it still may take you 6 months, a year to try to find the particular model that you want. So it's on the same side on supply chains. I think it's improving, normalizing, but still nowhere near normal conditions.
Seem you're making an interesting point here too, because you're actually bringing in and looking at it from a global perspective too. How vulnerable is Canada's economy when it comes to that, the global impact? We have an upcoming election in the next year, I believe, south of the border. We are seeing some significant dynamics changing. We are dealing with a war in Europe and others. How are all of those factors impacting our economy right now? And are there any ways that maybe this government has to move forward that we maybe are not seeing, and making and securing it and making it safer for us and business to invest in Canada?
Another tough question. I mean, I would say what's happening south of the border has always been of paramount importance for Canada's economy. So if the US economy falls into recession, and there have been questions similarly in terms of looking at those needles, is it in recession, not in recession? I think it's difficult, though possible, to imagine a scenario where the US economy falls in recession and Canada doesn't, but it seems unlikely. We have a higher level of indebtedness in terms of consumers on this side of the border. Our housing market, where in the US side, they had really had their big implosion back in 2007 when you had all the mortgage lending crisis problems. Their households have really deleveraged and housing markets have relatively stabilized, and things are more or less back to where they would have been in the US, whereas I think the opposite's happening in Canada. You've seen housing prices, continue a lot. So that, I mean, I think the big vulnerability, my point is that we have a high level of indebtedness, both in the business side, but also the household side. That makes us a bit more susceptible to these external shocks. The biggest shock would be coming from the US, but we've just lived through a shock the last year with Russia's invasion of the Ukraine, which has had very significant impacts on global commodity prices, on food prices and the like, and that's impacted both companies and businesses. So I think it's difficult to I mean, we're a small open economy, we trade a lot. Our trade sector has helped keep the economy going, and that's one of the bright spots that we see. But that's going to continue to be a channel through which shocks will be propagated from other economies into ours.
Yeah. And on that note, when we look at sector specific and how they've adapted to the evolving economic conditions, I was wondering, Paul, if you can shed a little bit of light on the financial sector and what measures you have taken to ensure stability and resilience in the face of any potential crisis. When you look at your organization saying, like, we're looking at it differently, I'm seeing factors and how we're moving forward differently, and just specifically to your sector.
Thanks, Mishka. So the financial sector, especially in Canada, we've got a certain liquidity that we've got to maintain. The banks have a certain level of liquidity. The credit unions have an even more conservative liquidity number. And certainly over the last 12 to 24 months, Meridian has taken a lot of, put a very strong lens on improving our liquidity. We were recently offering a new share subscription. So it's a private shares offering that goes towards boosting our liquidity. We're also trying to be market leading with our GIC rates to help our liquidity as well. So it's definitely front of mind for our financial department. I wouldn't say we're never concerned about it, but we were always, again, very safe to begin with to handle what had happened. We just don't know what's coming down the pipeline. So we want to make sure we're in even better shape than we were before. But that's really the best insulation we can have, is improving our liquidity numbers.
Excellent. I was wondering about one other thing. I think for those of us who are in Niagara right now, and we are hearing a lot about our current air quality, the second time, I think, in the last 4 weeks, that has been impacted by environmental elements and the environmental and climate crisis that we have, from wildfires to floods and other areas that we are dealing with. When you look at that, do you feel concerns about the economy, maybe by looking at, are we as committed as we need to be to sustainability? Are we looking actively as a country at reducing environmental impacts? We here at the GNCC hear more and more from businesses in their commitment to ESG and their commitment to the sustainability, to the environment. They have really put it at the top of their agenda, and it's also driving many of their economic and investment decisions. So I was wondering, maybe Jordan, if I bring it to you, and then Paul and Stephen, just as I would appreciate your opinion on this. And it's also a question that has come forward from one of our listeners too.
Yeah, no, a fantastic question. And I just want to do a quick response to the last topic. Just, it's almost a fun fact that I've been sharing with the members that I work with, because there's so much doom and gloom sometimes about bank failures and so on and so forth. So the actual last, CDIC insured bank failure was actually in 1996. And it actually only affected about 2,600 people for about 42 million worth of assets. So think of, for the better part of a couple decades, all the fear, the doom and gloom. So the Canadian banking sector is so highly regulated. The Charter 1 banks, credit unions, there's not very many of them. I think the number is about 34 to 36 banks. The States has over 6,000. So, when you kind of hear about things happening in the States, it's definitely a different animal than the very highly regulated environment that we operate within Canada. So just wanted to add that. But yeah, I mean, the environment, it's such an interesting topic there too, because, what I saw personally was, I remember before the pandemic, there was such a big push for, the clean energy transition and the environment and sustainability. And then all of a sudden you have a period of crisis. And I remember during that period of crisis, oil actually got to be negative in the futures market. It was $30 a barrel. We all assumed that everyone was going to be working from home. And, the way we were going to live our lives was permanently altered. And then all of a sudden, and it was a big push for tech in that environment. And then all of a sudden the pendulum swang the other way in 2022, where it was, pump as much oil as you can. We don't care if it's dirty. I mean, Germany fired up its coal-fired power plants again, which you think is unheard of, especially in Europe. But they needed the energy to combat, effectively the Russia-Ukraine war and the supply disruption. So when you look at it, you go, that's a very, telltale period where if there's a crisis, things that are maybe people perceive as not essential, but, meaningful get, put on the back burner. Hey, I need to feed my family. I need to put gas in the car. I can't afford gas at $2 a liter. That takes priority. Now, what I'm seeing this year is a lot of those themes that were so important, that clean energy transition, are exploding again. So good example is Tesla is now becoming, seemingly the standard for electric vehicles, where GM, Ford, and I just read Volvo are adapting that technology. They're all sharing the same supercharger network. The other piece is a lot of the clean energy companies themselves were growth companies. So those growth companies tend to have earnings that might be 5 or 10 years out. Well, high interest rates crush the value of those stocks. So even members that we might work with say, well, I want to invest in clean technology or things that are environmentally positive. Those actually had a disproportionate decline last year than things that were defensive, like a grocery store, or some of the commodities companies. That's changing. I think what we're going to see moving forward is, as we eventually enter a declining rate environment, that's a tailwind for some of those growth companies. And as, the push in society continues, and continues to resume, because I think there's always that desire for that clean energy transition to happen. I think it's, going to be great for us, both in Niagara and in Canada as a whole, but also from an investment standpoint, for those sectors. And I think, we're hearing more and more about it this year in terms of, just the push or the focus. And even one stat that I thought was interesting was, Europe expects to use 90% less Russian oil this year. So you might actually argue that as much as 2022 hindered the clean energy transition, it also might have accelerated it moving forward. Because, for Europe to get off Russian oil, they also had to, invest in wind, solar, and alternative energy sources, which is happening. So I think it'll be a big theme in the coming years for sure.
I think you're making it's a great point, John. I traveled to Netherlands and Germany in last December. And when I talked to individuals there, and it was really interesting to hear how many people said, yes, it's difficult right now, this energy crisis and the impact it has on them. But in the end, they said, we will be leaders in that industry. We're moving and we're moving faster and we're forced to move faster to it, which I think is a key point. Paul, do you see with businesses and individuals you're working with that you and they are looking for an increased commitment to sustainability, reducing the environmental impact?
They definitely are. It's probably about 80% of our people are now asking that question. So it needs to be a big part of our product shelf to say, I've got something for you that speaks to your values. It is still a bit of a challenge though to show to get the smart money to move towards green energy, environmental. The trend, as Jordan said, the trend is moving in the right direction, but a lot of it is from getting it all away from oil to green energy. We're really only in the second inning of that game. And when we have a year like last year, as Jordan was saying, where all of a sudden the price of oil shoots up and stays up, the money goes away from green energy because things like small nuclear reactors or small modular reactors, which are being put out as an idea now, there isn't a single one that's built yet, but it's where a lot of money is going. That money is not going there like it used to be because now it can go to Suncor where they've got proven income. So it's the dollar is actually still kind of speaking towards where I can make the most money. And it is a challenge to get people away from saying, yes, Suncor is making money right now, but where are they going to be in 2 years from now and 5 years from now? We have to look further out. So it's that short term versus long term saying, yeah, green energy might not look that affordable or that profitable right now, but you want to get ahead of the game. So it's a very much changing the behavior. People want to be in that space, but it's still hard to prove the profitability and the returns when some of these companies don't even have a shovel in the ground yet.
Yeah. And Stephen, to bring you into this dialogue, this really important dialogue, I and all of us are probably following the impact, not just the natural impact, the impact has environmental and climate crisis has on individual, but also the costs to businesses and the costs to the public sector in being able to manage it. When you take a look at it and the effects of a commitment to increase sustainability, while at the same time really needing to reduce the environmental impact that we're dealing with right now, how will it impact our economy? Where do you see we need to maybe move forward in a direction like we haven't done them beforehand, like many levels of government might not even be set up to consider?
Yeah, this is a huge issue for for the economy, for future generations, and for people living right now. I think what we've seen, you mentioned wildfires and the smoke happening there. We're a little bit farther north. I'm in Ottawa, and there's been several days of the last month where you're not really suggested to go out and do physical activity, and people are wearing N95 masks because the air quality is really poor. We do have a lot more extreme weather, and I think that there was debate, let's say 5 or 10 years ago, in parts of North America where there was resistance to the idea that really climate change is an existential threat. I think now we're at a point where society has more or less understood and embraced that. There's not much pushback, and even some of the most heavily engaged energy companies now are trying to lead this transition. So I think it's clear that we need to go there. There's big investments required. For Canada, this is going to be a bumpy and challenging time because of the regional nature of our economy and the regional nature of energy deposits, where we've got Alberta, Saskatchewan, and Newfoundland to a lesser extent, but all those 3 provinces particularly exposed from an economic perspective if they're not able to continue on the basis that they have been for years, and funding the rest of the federation as well with some of the energy revenues. So I mean, I think that's the threat to those economies, but I think we're also really well positioned as Canada to lead this transition and help the planet get to a point where we need to be in net zero And even think about just displacing dirtier sources from whether it's coal in China or oil from the Middle East. The Canadian labor standards are better. Our environmental protections are better. And I think in a transition period, I think Canada, because we both generate a lot of CO2 emissions and GHGs, we're also well positioned to do carbon capture and storage, because that's the area where we can benefit from that side. So I echo the same points that were made before in terms of the importance of this, and to say that I think if anything, Putin's invasion of the Ukraine got folks focused on the importance of energy security, and has forged some new alliances and really redrawn the maps of supply and secure supply. And I think if anything, that's probably been long-term helpful for Canada's economy, as somebody who's going to be viewed as a dependable, reliable supplier of energy to different economies as well as our own.
On that note, actually, we have spoken and touched on a number of sectors and the impact on our economy. And I was wondering, Stephen, if you could also talk about the impact of AI on the economy and where you think it will go to in the future. There's a lot of conversations about it. There's volatility when we look at stock markets and others in the power and the way it might shape our economy down the road. But where do you see its impact?
Well, I think if Paul said we were in the second inning of some of the clean tech, I don't know if we're in the batter's box right now. We're warming up, but maybe we're swinging and starting to sing the national anthem. I think AI is really exciting. I think for a lot of folks, for our business data lab, we are taking advantage of some of the tools of generative AI, and it's helping some people working in areas to really replace some of the repetitive lower value added tasks, and like other transitions we've had before, other technologies. That's a good thing. I think we thought many years ago when we had 50% of the economy engaged in agriculture, people would have thought, well, if people aren't farming, then now we're down to 2%. What will people do? And I think the types of jobs, the opportunities, the things that are going to come from this transition, and it is going to be absolutely incredible. But there's a lot of threat and fear for people that they may be losing their job. I think one way we try to look at it more from the task perspective of which tasks could be easily automated, and then how will that change the nature of job descriptions and what people are doing. I do think we're at a similar stage as we were in probably the early to mid 1990s, where we had starting at the widespread adoption of the internet, and economists looking at productivity statistics and being very flummoxed to say, well, why is it that you look around, you see personal computing devices, and we don't, we start to see the wider spread adoption, but we didn't see a technology boom. But then in the US from 1995 up until 2001, when we had the tech crash, we saw a really big increase in productivity. I think we're probably at the same point now where there's a lot of kind of low valued or obvious applications of AI that people are using that are, again, relatively replacing things that were done before in a similar fashion, only with more efficiency. If you think about ChatGPT-4 and other things that people are looking at, there's a lot of opportunities, I think, going forward for that. So we'll probably see some of these big productivity gains in the next 5 or 10 years, but not right now. But I do think on net, there's going to be some big changes, big social changes. But also I think a lot of folks looking at optimistically to say that there's going to be some good things coming out of this, and some good opportunities for people to really focus on things that they care about, and adding value in ways that are not done just automated computer tasks.
I think this is the reflection that I see and hear in many of the conversations too, that people are actually optimistic about it, cautious in some areas of it, but overall that we are seeing a shift that is actually a shift that is welcomed at the same time. Another sector, and maybe Jordan, if I can bring you into the conversation, is that Naga in many ways has been defined by its hospitality, its tourism, its agritourism sector, its wine industry. And we have over the last couple of years, some of what we have seen is that this sector has been really hard hit, and it has been difficult. I mean, I look especially at agriculture too, and its dependence on the weather and the climate. There could be another risk there. But can you speak to the current state of the tourism industry, and maybe where you see some of the potential of future, or when you talk to businesses, Are we seeing a growth sector? Is it still going to be a growth sector for Niagara? Or where do you see opportunities?
Yeah, sure. No, happy to chat about that. So I think as Meridian actually as a company, we've got a fair bit of a toehold in terms of a lot of the hospitality businesses in Niagara. So it's kind of neat to kind of see some of the back end. No secret that was a challenge during the pandemic. You had people that just flat out were told, do not leave your house, do not travel outside of Ontario. Ironically, there was a period where do not travel outside of Ontario meant come to Niagara. So, I mean, and I think you kind of see it, you just use the term again, distortion, supply and demand distortions that were caused by this unusual environment that we're in. And I think you kind of see it where there was periods where nobody wanted to travel. If you remember the new variant, COVID variant at the end of 2021, all of a sudden people are clearing their calendars. There's no international travel, canceling flights. And now we've kind of seen this recent period where there's been, I would say an explosion of people making up for lost time and traveling, which, it means that a lot of our Niagara hospitality businesses have been really busy. And I think it just goes back to getting to a state of normalcy. We just talked about some of the statistics that might lead to, implying that the hospitality industry might be or continue to be healthy, which is just, things like retail sales. Is the consumer still spending? And we saw retail sales come in, I think for April at 1.1%, higher than the 0.4% that was expected. So, you just kind of see if the consumer is resilient and they haven't had the opportunity to travel as much as they might want over the last couple of years. I think that's going to bode well for the Niagara hospitality industry in the coming months and years.
Yeah. Paul, we had mentioned the housing market, the shortage of housing and housing stock, and at the same time, the challenge that individuals are facing with an increase in interest rates and mortgage rates. What are you experiencing on your end? And are we going to see that a lot of individuals have to turn away or sell the houses that they thought they could afford?
Yeah, we're actually definitely seeing a lot of that. People that 2 years ago could have easily bought a house that was on their wish list. Now we're saying, I'm sorry, but you're declined. And the house that they wanted isn't even available anymore. So we are starting to see a little bit more stock, especially in Niagara. We are starting to see the stock numbers come up a little bit, some more for sale signs. But we're definitely seeing houses also stay on the market a little bit longer too, where 2 years ago you'd have a bidding war. In Niagara, you're seeing people where they're getting the price maybe that they want, but it took them 6 months. On the seller side, it took them 6 months to get that price. You didn't have necessarily a bidding war. And it's a challenge where people are having their mortgages come up for renewal this year, where we're having to say to them, you took your mortgage out 5 years ago on a 25-year amortization, so you should have 20 years left to pay it off. Well, you actually now have 30 years to pay it off because your mortgage payments aren't even covering your interest anymore. So we call that non-amortized mortgages. And we're seeing people where they're coming in expecting to just renew their mortgage, and we're like, you have to increase your payments by $500 a month. Well, I can't. Like, there just isn't the discretionary money available for that. So from my own anecdotal, we haven't seen anybody where they've had to sell their house, but we've certainly seen a lot more pressure on their disposable income that they weren't expecting. Some people where they're having to remortgage 30 years or further. And we're saying to people, maybe instead of renewing for 5 years, you might have to pay a higher rate. We talked about the inverted yield curve, but maybe just take a 2-year term instead of a 5-year term, so that when the rates do eventually hopefully start to come down, you can then lock in again for another 5 years. So it's affecting the stock, it's affecting the ability to get approved. We're seeing a lot more parents having to go on mortgages because 2 incomes isn't enough. So it's a massive shift in the lending, in the purchasing. It's a huge challenge.
Yeah, we hear the same. I'm going to pass it over to you, Stephen. On July the 4th, this upcoming Tuesday, we're hosting the Honorable Randy Boissonnault, Minister of Tourism, who's also the Associate Minister of Finance. What would you ask or like to ask of the federal government when it comes to our economy and stabilizing our economy, and especially ensuring that we're seeing growth in our economy?
Well, I think so. Perrin Beatty, my boss and our president at the chamber, was certainly talking about this a lot. And I mean, I think first and foremost, we'd like to see a stronger focus on growth and the challenges that we're seeing on the economic growth side. This government has not been as attuned to those issues and as friendly to overall business and making big investments in Canada as I guess they should. Improvements in terms of the regulatory environment, so making things easier to get done in Canada, and then a commitment to try to get fiscal policy. We've had very big spending, very big deficits, to try to get things back, to get the house back in order, and trying to bring things back to some sort of balance going forward, and avoiding increases in unnecessary increases in taxation if that's possible.
Yeah. Thank you very much. And I think that is a perfect way to actually conclude today's webinar. Stephen, Paul, John, I actually wanted to, my personal thanks to you for being part of it. This has been really an informative dialogue and a much appreciated one, and one that we have really received a high number of requests for. So it's very timely. My thanks also go to Meridian Credit Union for bringing us all together and making this possible. And lastly, to all the participants, thank you for joining us. This recording will be made available on our site as well. You will receive it via email following today's Espresso Live. So thank you for that, and wishing every one of you a great long weekend.
Thanks very much.
Thanks for having us on.
Thanks a lot. I appreciate it.